Welcome everyone to the newest edition of 3 and 3. This is where we cover 3 topics from our most recent conference call in 3 minutes. Federal Reserve mandate, inverted yield curve, and credit spreads. Federal Reserve mandate. The Federal Reserve works to promote a strong U.S. economy. Congress directed the Fed to conduct the nation's monetary policy to support maximum sustainable employment, stable prices, and moderate long-term interest rates. That's defined as an inflation rate of about 2% and unemployment between 4.1 and 4.7%. As you can see, during the Great Recession, unemployment peaked at about 10%. It's been coming down ever since. So recently the Fed has been raising interest rates as they feel more confident about the unemployment rate. Inflation. Inflation bottomed out in about 2010. And since inflation is also now over their 2% target, the Fed is continuing their interest rate policy, and probably into 2019 they'll continue raising rates also. Inverted yield curve. The inverted yield curve is when long-term debt instruments have a lower yield than short-term debt instruments of the same credit quality. The Federal Reserve wants to slow economic growth to prevent inflation, so they're pushing up short-term interest rates, and that inverts the curve. It's considered a predictor of economic recessions. The Treasury yield curve inverted before the recessions of 2008, 2000, 1991, and 1981. And you can see those inversions in the history, and this is the inversion that occurred in 2007 before the Great Recession. We are getting close to inversion, but we're not there yet. Credit spreads. Credit spread is the difference in yield between 2 bonds of similar maturity but different credit quality. Higher quality bonds typically have a less chance of defaulting, so they offer lower interest rates. Lower quality bonds, like corporate bonds, have a higher chance of defaulting, so they offer higher interest rates to attract investors to riskier investments. Credit spreads widen when the U.S. Treasury markets are favored. That's typically in times of uncertainty or when economic conditions are expected to deteriorate. Widening credit spreads can act as a leading economic indicator for asset prices. Again, you can see credit spreads were very tight leading into the Great Recession, but then they blew out into 2008 and 2009. They've been coming down ever since, but we've had periods of volatility. But being that they're very tight right now, it tells us the economy is doing very well. Thank you again for joining us for 3 and 3.